You're listening to international investment advisor Doug Goldstein on the Goldstein on Gelt show, the financial show where we'll talk about how you can make the most of your money. With all the confusing financial chatter bombarding you each and every day, Goldstein on Gelt will give you the practical information you want and need about living a financially stable life. Here's your host, money maven Doug Goldstein.
Okay, we are back. I'm very happy to have on the Goldstein on Gelt show Harry Dent, who is perhaps one of the most well-known economists. You've seen him on all over the news, from CNN and Fox to Bloomberg. I actually know Harry since when I started on Wall Street over 20 years ago, because we used to study the work that he did and his research, and he's still a hot name on Wall Street. And in fact, his newest book is a recent update of a book he wrote. The book is called The Demographic Cliff: How to Survive and Prosper During the Great Deflation Ahead. It's coming out in paperback right now. You should definitely get the newest version. Harry, a real pleasure to have you.
Oh, nice to be here, Doug.
Now, Harry, one of the things that I'm thinking back to when I was literally in stockbroker school, and people would talk about you, and they say, "Oh, demographic dent," and you always seem to base all of your predictions just on demographics, which was so different from what everyone else did. Why is that?
Well, it's the most important predictions. Demographics is the most fundamental trend, and it's also the most projectable. I can tell you, when there's going to be major downturns decades in advance, when the economy is going to boom, and in different countries. We predicted the Japan decline in the late 80s when people thought Japan could never do any wrong again, and we predicted in the late 80s at the same time that the baby boom in the United States would keep driving up its economy until 2007, and ever since then we've had constant quantitative easing in countries like the U.S. and Europe to fight this natural demographic downturn. People enter the workforce at an average age. They have kids at 26. They buy their first home at 31, their second home, largest home at 41, 42. They peak in spending at 46. And then they save more, and that's the problem. Baby boomers around the world are saving more. Israel happens to be an exception because you have much stronger demographics and higher birth rates, but most developed countries are aging and declining, and economists ignore it for one simple reason, Doug: they never study demographics. They don't even want to think it matters. It's the most important. We have many other factors we study. It is the most important factor, and it even has told us when inflation is going to rise and fall decades in advance. Well,
don't you think that it's true? I understand demographics and people do get older, but quite frankly, the economy seems so different now from how it was when our grandparents were dealing with it, given the internet, and just the speed of development is so different. Do demographics really still matter in that? I mean, it's really a paradigm shift.
Well, first of all, demographics started to matter after World War II because of the innovations in automobiles and electricity and phones, which created the first suburban middle-class populations in history, where broad numbers of people had high incomes and could afford homes and mortgages. That didn't exist before then. Technology made that possible. If you look back through history, about every 45 years, you get major new technologies that move mainstream and change life. Yes, our lives are much different than our parents or grandparents, but their parents' and grandparents' life. Can you imagine life before the telephone and flush toilets and electricity?
Oh man, you're scaring me. Don't talk. I don't like that thought. That definitely. So you're saying that even giving the changes, there's always some sort of technological change that we're seeing, which allows some sort of prediction. But there are a lot of people who look for cycles. Like, people now are talking about there's a 7-year cycle, which they begin to see. And frankly, given the shakeup in the market recently, is that also related to demographics, or are there just multiple cycles that weave in and out of each other?
I have 4 key cycles, a little longer term: a demographic one, an innovation one, 45 years, a geopolitical cycle, which is very important, especially in the Middle East and places where that's a hot button, every 36 years, and a boom-bust cycle on average every 10 years. And then our shorter-term cycles boil down to a 7-year cycle. I agree with that one. You go back 7 years and there's been some type of substantial recession or stock crash all the way back to the 60s. And then we have a 2-year cycle. Corrections are more likely. So the 7-year cycle hits here in 2015, and the next 2-year cycle hits in 2016. all of our other 4 major cycles, and Doug, this is very rare, only once in a generation and twice in a lifetime have we seen these 4 fundamental cycles that I've tracked back 100 to 200 years turn down at the same time. 2014 to 2019 is the next convergence, like the mid-70s and the early 30s, which were the 2 worst economic crises and stock crashes in the last century. So I'm not just looking for a correction here in the markets. Demographics point down from 2008 to 2022 in the U.S. and farther down in other countries, and we've got these 4 cycles pointing down into the next 4 years. I see a major financial crash and crisis, not just a correction as we've seen starting in late August.
We're talking with Harry Dent, who is just re-releasing his book, The Demographic Cliff, How to Survive and Prosper During the Great Deflation Ahead. The newest version is in paperback, which has new material. Harry has been giving us, quite frankly, a rather pessimistic view of things. I want to touch on one particular point you made, is that you said there's a 36-year cycle as it relates to the Middle East, as this is a hot topic for the listeners of the Goldstein on Gelt show. Harry, tell me a little more what we should be looking for.
Yeah, it's a geopolitical cycle. It tends to be positive for about 18 years, like 1983 to 2000. Ask yourself, what went wrong in the world? We had a 100-day war with Iraq just to kick them out of Kuwait. But since 9/11, what have we seen? One geopolitical disaster, one civil war, one revolt, Russia moving into Ukraine, terrorism rising and rising, ISIS replaces, Al-Qaeda. This is what happens in a negative geopolitical cycle, and the impact it has on obviously it has impacts on politics and all that stuff, but it tends to cut the price-earnings ratios, the valuations on stock, in half into a down cycle because investors see higher risk. There was no risk in the world from 1983 to 2000, but 2001 to now, the risk just keeps going up. So that's our second most important long-term cycle. And if I'm in Israel, sitting in the Middle East, it's even more important because I'm surrounded by the most tumultuous area in the world right now.
All right, so I know that you've tried to put numbers onto these predictions, and of course a lot of people are following what you're saying and they trade based on what you're talking about. Do you feel that sometimes it's difficult to put the numbers? I'm just trying to remember, and I don't really have the exact figures, but it used to be that I thought you were much more optimistic. You had said numbers like Dow 20 or 40,000, and it obviously didn't hit that. How do you put real investment figures onto these kind of theories?
Well, this one, the best indicator we have is called a spinning wave, and I can do this in any country, but in the United States, it was up from 1983 to 2007. It's just a 46-year lag on the birth index, and I have to adjust for immigration because those are real people, and I can do that with a computer model very accurately. That model shows the magnitude and said, hey, the Dow ought to go up, somewhere around this much. And the real target would have been like 16 to 20,000, and we got close to that. And now it says, hey, we're probably going to go down to 3, 4, 5, 6,000 in the next several years as this trend turns down. So, but you're right, the magnitude is the hardest to predict. The turning points are easier. In other words, we would have told an investor, you can have a buy and hold strategy from the beginning of 1983 to the end of 2007. After that, you better have a more flexible system or just get safe and protect your assets. Because when you have government step in and pump all this money in the economy, that's not something that has anything to do with demographics or these cycles. And that can pump it up even higher. So I look at, we're the best at giving people times where investment is better and more productive and when you need to be safer, and that we've been extremely good at.
Mm-hmm. And one of the issues that I know that you focused on is the issue of deflation as opposed to inflation. Tell us what you mean by that, because I think it's a little bit of almost a political figure at this stage, and why you think that's the direction we're going.
Yeah, well, inflation happens, 2 major factors. Beyond government monetary policy, that's the smallest part of it, or OPEC embargoes. Inflation happens when a young generation's entering the workforce at great expense to raise them and get them offices and everything in between, educate them. And when the old technologies, like you talked about, these major shifts, are petering out, productivity's going down. That's what we had in the 1970s. Then we had this great bubble boom. That happens in what I call the fall season, when inflation's falling, interest rates are falling, the new technologies are moving mainstream, and a generation's spending money. Everything's as good as it can be, like in the roaring 20s. What follows that is the winter season, deflation. You get financial bubbles from credit bubbles and overspending and overexpansion by consumers and businesses, and you have to flush all of that out, and that's what happened in the 1930s. A bubble boom in the roaring 20s with credit expansion, financial asset bubbles, stocks, real estate, everything, crashes, and a lot of deleveraging of debt and wealth happens. And so deflation is the most painful part of the cycle, just like a cold winter is. But long term, it resets the economy, forces massive innovation, restructuring, rewards the best businesses, flushes out the bad ones, gets rid of a lot of debt that you don't need anymore that didn't work, and a lot of businesses that failed. And now you're in a much stronger position with lower cost, lower interest rates, all this sort of stuff to expand again. And that's what we did after the 30s and World War II. We had one of the greatest booms in history with low inflation despite the expansion. So we're in that stage. We've been going into the winter season. Governments have been fighting it with quantitative easing. Now we're going to have this crash and this reset, and it is going to be painful, and it needs to happen is what I'm saying. All I can do is help investors and businesses prepare for it and prosper rather than see their net worth wiped out or their market share wiped out. The strong are going to do very well. Everybody else is going to get crushed for a while. And then we'll go into another great boom with a whole nother new set of technologies.
All right, well, we will look forward to that. And Harry, unfortunately, we're out of time, though. I am, of course, very curious to learn about what you're teaching people, how to deal with what you see as the quite a bear market that it looks like we're talking about going into. But unfortunately, we're out of time. So tell me in the last few seconds, how can people follow you, follow your work, and maybe learn some more of your ideas?
Well, we have a free daily newsletter that people can get to know us, Economy and Markets. Go to dentresearch.com and look for that. And, of course, we've got a whole array of products and services there as well.
Okay. Harry Dent, I really appreciate your spending the time. We will put a link to that at the show notes of today's show at goldsteinongelt.com. Once again, thanks very much, and have a cheering next couple of years.
Okay. Thank you, Doug.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.